Equity Market Update, July 2023. Indian equities continued to witness a broad-based rally in July, and Nifty and S&P BSE Sensex ended the month near all-time highs, up approximately 3% over June 2023. The mid-cap and small-cap indices outperformed the large-cap benchmark. The rally was supported by consistent buying by FPIs, resilient global growth, especially in the US, and the narrative of soft landing taking hold in the backdrop of receding inflationary pressures. Key events during the month include Bank of Japan effectively widening YCC reference points to plus or minus 1% from plus or minus 0.5%. US Fed, ECB and Bank of England raising rates in line with expectations, Chinese government announcing measures to boost consumption and support real estate, remarkable improvement in progress of the monsoon, etc. Most major sectors' returns delivered positive returns, with power, capital goods, metals, healthcare and oil and gas being the key outperformers. Performance of major global equity indices was also buoyant, led by the US and Hong Kong. FPIs bought equities worth $4.1 billion in July 2023 and have cumulatively bought equities worth $17.8 billion in 4MFY24. On the other hand, DIIs sold equity worth $0.3 billion in July 2023 and have cumulatively been marginal buyers during the first 4 months of FY24, vis-a-vis net buying of $17.9 billion during same period last year. Flows to mutual funds ticked up to INR 8,600 crore in June 2023, compared to approximately INR 2,500 crores a month before. Cumulatively, DII flows have moderated in Q1 FY24 to approximately INR 16,500 crores, compared to approximately INR 78,300 crores in the same period last year. Of the Q1 FY24 results declared so far, results of banks, oil and gas, auto, pharma and capital goods were better than expected, while those of cement, NBFCs, metal and utilities were in line with expectations. Results of IT, consumer staples, consumer durables and chemical sector were lower than expected. Outlook. As on July 31, 2023, Nifty 50 was trading at approximately 18.4 times FY25E price to earnings multiple. Despite the rally seen in the past 4 months, valuation multiples are below the recent peaks but at an elevated level vis-a-vis the historical averages. Market cap to GDP stood at approximately 95% based on CY24 GDP estimates, and the gap between 10-year GSEC yield and 1-year forward Nifty 50 earnings yield remains higher than historical averages but lower than the high seen during last year. However, one should view these valuations in the context of structurally attractive nominal GDP growth, a robust economic recovery, a healthy corporate earnings outlook and robust delevered corporate and banking balance sheets. The valuations for most major sectors are higher than long-term averages. We remain positive on equities over the medium to long term, considering the structurally robust domestic growth outlook, healthy corporate profitability and growth supportive policies. A sharp slowdown in global growth, escalation of geopolitical tensions, and re-acceleration in inflation globally or locally are material near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.